Hello. In this video, we'll be going through a sales type lease with selling profit. A lease is a contractual obligation or a contractual arrangement where there's a lessor who's the owner of an asset and they lease the asset to the lessee, the user of the asset. So the lessor gives the lessee the right to use that asset, and in exchange, the lessee gives the lessor cash payments. Think about yourself if you rent an apartment or if you lease a car. There's the owner, and you get to use either the apartment or that car in exchange for monthly payments. For accounting, there's different classifications for leases depending on the facts and circumstances within the contract. The lessee has either what's called a finance lease or an operating lease. And a finance lease is more of, quote, a sale. It's a lease, but it's structured so that it looks more like a sale. The lessor can have a sales type lease, again, where it's more like a sale rather than a lease, but it's not an actual sale. And just like if you had a sale, if a company had a sale, they could sell an asset with profit or with profit or without profit. We have a separate video for how to account for a sales type lease without selling profit. In this video, we'll be going through how to account for a lease with selling profit. It's only slightly different than the without selling profit. And the lessor can also have an operating lease. A sales type lease with selling profit occurs, just like I said, when it's quote unquote like a sale, where there's a difference between your sales revenue and your cost of goods sold. This happens when the fair value of the asset that's being leased is greater than the cost or the carrying value of that asset. Okay, so if you have an asset that's the fair value is $100 and the cost is $80, then you would have, and you lease out that asset, then you're going to have a profit, sales type lease with selling profit. This bullet point right here, the lessor also recognizes interest revenue over the lease term. This is the same whether you have a with or without selling profit. Okay, that does not change. It's just the first two, the second bullet point is when things change. Let's go through this example, and this example is very similar to the example we did with a sales type lease without selling profit, except for one nuance. On January 1, 2027, Sans Serif Publishers leased printing equipment from CompuDeck. So Sans is the lessee and CompuDeck is the lessor. The lease arrangement specifies 6 annual payments of $100,000 beginning on January 1, 2027, the beginning of the lease, and on each year from December 31 from 2027 through 2031. The 6-year lease term ending December 31, 2032 is equal to the estimated useful life of the equipment, which tells us this is a finance/sales type lease because it meets one of the 5 criterias. And this is where it's different right here, this bullet point. CompuDeck manufactured the equipment at a cost of $300,000. Okay, that's their cost. Using an interest rate of 10% for financing this transaction, CompuDeck calculates the present value of the lease payments to be received as $479,079. So this right here, this present value of the lease payments is what's considered to be the fair value. And now you see in our cost is $300,000. Our fair value is $479,000. So that's when your fair value exceeds the cost. So you're going to have a sales type with selling profit. Before we get into that, I just want to, we're not going to go through the journal entries for the lessee side because those don't change. But on January 1st, the lessee would debit the right of use asset for the present value of lease payments for $479,000 and credit lease payable for that same amount. And because it's finance lease slash sales type lease, the lessee records the asset on its book because we're going to treat it more like a sale. And if we're going to treat it more like a sale, which means that the lessee purchased an asset. So this is just to show you that it's the same with or without selling profits for the lessee side. Now now I just want to remind you, if there's no sales profit, so this is what we just went through, the lessor, okay, this is a different lessor, but the lessor would debit lease receivable for the present value of the lease payments, and they would credit equipment at their cost, which when there's no sales profit, the cost is equal to the fair value of the lease payments. So, the cost is equal to the present value of the lease payments, which equals the fair value. So this is just to show you we would debit lease receivable $479 and credit equipment $479 for no sales profit. Now I'm going to go back to our example here when we have with selling profit, where the cost of the equipment is $300,000, not $479,000. So Compudec Corporation is the lessor. Here we have a lease receivable for the present value of the lease payments for $479,000. We're going to credit our equipment at our cost, which is $300,000. But now, because we have this sales type lease, if we were to sell this, we have to treat it like a sale of the asset, which means we would credit sales revenue and recognize $479,000 of sales revenue, and we're going to have to debit our cost of goods sold for $300,000. Okay, now, so therefore, we have a profit on our income statement for $179,079 because we have sales for $479 and cost of goods sold for $300. So the difference is your profit. This is the same. This slide has the same entries. They're just broken out into two different entries, just so whatever you prefer is easier for you to understand. This is just, it makes no difference. Okay, the example also says that the first lease payment is also on the first day of the lease. So we're going to debit cash. The Compudec, the lessor, receives cash. So we're going to $400,000, and we're going to credit lease receivable for $100,000. Again, this is the same with or without the selling profit. Okay, this particular entry. Nothing else. No, the rest of the entries to account for the sales type lease, when you have to account for the reduction in lease receivable and you have to calculate the interest revenue, does not change. The only entry that changes with the profit when you have a selling profit is this one right here. Let's do a concept check. Leaseco Industries leased equipment to User Corp on July 1, 2027. Leaseco recorded this lease as a sales type lease at $810,000, the present value of lease payments discounted at 10%. The lease called for 10 annual lease payments of $120,000, each due July 1. The first payment was received on July 1, 2027, which is when the lease began. Leaseco had manufactured the equipment at a cost of $750,000, and we need to calculate what this impact would be on Leaseco's December 31, 2027 income statement. There's two things here that's going on. One is the selling profit, because it tells us that the fair value, which is the present value of the lease payments, is $810,000, and we know that the cost is $750,000, and so our selling profit is going to be $60,000. So that's step one of what impacts the income statement, step one. The second part is we have to recognize how much interest revenue Leaseco receives. And I like to set up the amortization table like this. I like to put the cash payment up here. I'm going to have interest revenue here. This is going to be my reduction in my lease receivable. And this is going to be my carrying value or outstanding balance. Okay, so on 7/1/27, we leased out this asset for $810,000. $810. Also on 7/1/27, there is a cash of our first lease payment. Now, because they happen to be on the same day, there is no interest component to this particular payment because it's on the very first day. So I'm going to reduce my lease receivable by that amount, and that makes my new carrying value to be $690,000. Okay, now, so that's my carrying value on 7/1/27 after the first lease payment. Now we have to calculate what's the income statement on December 31. So now December 31, the way I'm going to calculate my my interest revenue that I've accrued is I'm going to take my beginning carrying value of 690,000, right? Because that's going to be my balance on December 31 times my annual interest rate. However, I'm only calculating this from July 1 to December 31, which is only for 6 months. So I have to divide that by 2, that interest rate by 2, and that equals to $34,500 of interest revenue. So what is the total increase in earnings on December 31? It's going to be my selling profit of $60,000 plus my interest revenue of $34,500, which equals to, sorry about that, to $94,500. Hope that math is right.